Hello and welcome to Livewire Markets. My name is Anna Dadich and I'm joined by Dan Pietrzak, Global Head of Private Credit at KKR. He's going to share his insights of where private credit stands today and what could drive returns moving forward. Dan, thanks for joining us.
Great, thank you for having me. Great to be here in Sydney.
I'd love to get your perspective on the current state and outlook of the private credit market in 2025, if you could paint a picture for us.
Sure, maybe we'll start by just kind of, where we sit sort of market-wise, right? So, when most people talk about private credit, they're talking about direct lending. That market's grown meaningfully over the last, several years, probably roughly $2 trillion of assets under management. For us, though, private credit's a much bigger sort of definition. It's not just direct lending, it's junior debt, it's the bottom of the capital structure for a corporate. It's also the asset-based finance business, right, where we're financing the real-world economy. For us, that business has been a big growth story. That market's got a lot of white space, probably $7 trillion of assets there, and kind of continually growing as assets move out of the banking system. I think you ask an interesting question, kind of where we're at in 25, sort of what the outlook is. Where we're sitting here today at sort of the end of April, very different than where we thought we were starting the year, right? Everybody was starting the year that there was going to be, a pretty big tailwind on the back of the strength of the U.S. economy, on the back of, what the Trump administration would have been bringing to bear. He was viewed as a transactional president, anti-sort of regulation sort of president. We've kind of seen the reverse, right? The market's been fascinated, focused on all the tariff news, focused on, what does that mean? When will some of these kind of negotiations or these deals get resolved? You've seen a tremendous amount of volatility, right? I think that volatility has mainly been centered in the equity markets. Post-Liberation Day, post-April 2nd, you saw, big moves down in global equity markets. I think we've seen some of that sort of come back. I think as there's, I will say some realization that while tariffs will go up, I think there'll be a more muted sort of middle ground. But the outlook's a little bit tough to figure out sitting here today, right? I think we're of the opinion we walked into this, we walked into 2025 in a pretty good spot, right? We were still seeing revenue growth from the companies we lend to, still seeing EBITDA growth. That's a global sort of point. Seeing the U.S. consumer sort of strong. Ironically, Europe was kind of the weak story at the start of the year. That's kind of the reverse of that. Kind of flows are going there now. So I think the outlook is hard, but I think it's more of an equity kind of issue than a credit issue, right? If I think about everything that we're doing or everything the private credit market is doing, it's all about downside protection anyway, right? It's all about getting sort of a stable return. Clearly, this puts a little bit of additional risk in there, but I think the volatility that's there may actually present some more interesting investing opportunities.
Okay, great. So what role can private credit play in an investor's portfolio?
I think the investor demand has been really the driver of all this growth we've seen in the market. I think there's a bit of a misnomer out there that, the whole private credit market is new, or it's this kind of, set of new types of deals being done. This market's been around, in my mind, for, sort of decades. It may have been called something different. I mean, I've been doing this for 25 sort of plus years. A lot of stuff I was doing at banks, prior to my last 10 years at KKR, you could probably tag as sort of private credit. But if you think about it, in the U.S., there was BDCs prior to the financial crisis. There was a gigantic void that happened as banks took a step back there. More and more capital came in to fill that sort of void. But then I think people started to see, okay, we can get a stable return from a NAV perspective. We could get consistent sort of income. I think we've seen more and more investors, both on the institutional side as well as on the wealth and retail side, wanting more exposure to get some of those sort of attributes. I think most institutional investors have been increasing, their allocation of private credit over time. I think the big conversation today, though, is probably about diversification, right? Because I think while most people have done it on the institutional side, it's been direct lending. Now it's doing other stuff. If you look at all of the wealth channels, it's mainly been focused on direct lending only. It's probably been very U.S.-centric, right? Not very sort of global-centric. So I think the big conversation today with all of our investors is, can they add asset-based finance to their portfolio? Can they add Europe? Can they add Asia credit? so not just the U.S.
So let's talk about what's been happening with the spreads in direct lending. Has that affected investor appetite for the asset class?
Sure. No, very fair question. I mean, I think if you just go on a journey with spreads for a second, right? If you were, let's call it on the other side of COVID, but with still volatile markets, right? Spreads probably gapped out to 650 basis points. If you go to January of 22, they were probably down to 575, right? They probably gap back out with all of the rate volatility that sort of happened that really kind of threw the markets, a bit of chaos in 22 and 23. And then you sort of fast forward to, let's say, March, your regular way direct lending loan was probably, on average, let's call it, somewhere between 475 and sort of 450, right? So meaningful spread sort of tightening. Now, I think on the other side of that, though, rates have moved a lot, right? So if you use my January 22 example, right, the all-in return on one of these loans was probably 7.5%, sort of 8%, right? You were in a zero-rate environment, even at that 550 sort of level, that's where you were sort of capped, right? And if you kind of look at today, where rates are globally, and the U.S. kind of being the highest, at least from these developed markets, you can almost earn sort of 10% sort of unlevered on these loans. I think that has piqued investor interest because I do think most people are quite focused on what their total return is, and then a lot of pools of capital in direct lending are levered, right? So there's some form of debt, either fund level leverage, or if it's a BDC, or if it's one of these sort of other sort of wealth type products. The cost of leverage has come down though as well. So the spreads on the leverage has decreased. So I think, the levered investor has almost been insulated from these spread moves, at least somewhat insulated. And the unlevered buyer, I think, still remains interested because of just what that total return is. With this volatility, I think spreads are starting to sort of, move out a bit, but that's probably, 25 basis points, maybe a little bit more, but not a lot. There's still a lot of what I'll call dry powder out there. I do think if rates go down, you'll start to see spreads go out.
So what is your biggest worry or your downside case?
Yeah, well, there's probably a lot of worries today. I think if you are of the opinion that the U.S. is really willing to kind of drive the car into the wall at 100 miles an hour, sort of on the tariffs, like that will be significant disruption, right? I don't think that's the case, but I do think a recession in the U.S. is a real sort of scenario, if not kind of the base case. I think that's a temporary sort of thing. I don't think it's a deep sort of recession. It could, quite frankly, be good for the investing environment, right, to shake out some of the froth. And even that type of recession, or I think what we're seeing with the tariffs, I'm not that worried about our existing portfolio, and it's our job to worry about that, right? It's again, I think it's more of an equity thing than sort of a credit thing. We're generally lending to non-cyclical industries. Globally, we're generally lending to businesses that are larger in size. We think these larger companies have, better management teams, more levers to pull if something goes wrong. Our asset-backed business does have a fair amount of exposure to consumers globally. Probably a little bit worried about the U.S. consumer these days, but probably more worried about that subprime consumer, right? In the U.S., this lower FICO sort of score type consumer. That's not where we focus. We've done things much more to the prime type borrowers. I think the downside case is that the tariff sort of point doesn't get solved. It does create a fair amount of inflation, right? We'll pick on the U.S. here. The Fed's not able to take down rates, right? If anything, you could see rate pressure the other way. I think you'll see a significant loss of consumer confidence. Then you could be talking about a much more significant recession. And I think that would be sort of problematic.
So as competition is increasing in direct lending, how do you think about preserving quality in the portfolio?
Yeah, I mean, unequivocally, competition has gone up, and there has been a lot of money raised for the space. The other side of that, though, there has been more and more users of this direct lending product, right? More and more private equity sponsors are prepared to do these private deals. There are more and more companies that I think would prefer to not be in the public markets and be in the private markets. We've never had a view that the loan or bond market was going to go away, right? That these were always going to exist together. So I think the amount of capital that has been raised has been one of the reasons that spreads have been sort of pushed down, right? Because there is a fair amount of what I will call that dry powder. But I think the market has done a good job of holding, the line on certain structure and documentation points, right? I think we know that when we're making one of these loans that we are going to hold it, until we get paid back or its maturity date, right? I've got a view that we're like in the storage business with these sort of loans. So I think the market's been disciplined there. I think if we don't see things we're comfortable with as it relates to structure documentation, that's probably one of the biggest reasons we walk away from a deal. I obviously want to get paid, as would anyone in the market, as much as possible for any individual loan, but that last 25 or 50 basis points, it needs to be a good credit. It needs to have the right structure, the right documentation.
So where are you seeing white space in ABF?
Yeah, so maybe just take one step back again. When we talk about our asset-based finance business, we're talking about sort of financing the real-world economy, right? So everything that you sort of touch, right? People have a car loan or a credit card or consumer loans or mortgages, equipment leasing, aviation leasing, these kind of broad swaths of that sort of real-world economy. I think there's been a handful of things there. I think banks are doing a very good job of continually looking to optimize their balance sheet. Right, I think the banking system globally is in a pretty good spot. We view banks as a big partner for this business. From time to time we might buy assets from them. From time to time we might work with them on some capital solutions or these SRT type transactions. We've been active there. I think that bank partnership sort of route will continue. I think that's one. I think two, for our asset-backed business, we have started to work with companies that we, usually in this part of the business, we wouldn't kind of get access to, like large, publicly traded sort of global names. PayPal would be an example in Europe, where they used to have a fair amount of assets on their balance sheet. I think the equity market is punishing capital-heavy businesses, especially if they don't need to be capital-heavy. Right, so that would be an example where it was strategic for them. We ended up being the buyer of certain assets off their balance sheet. We've done a handful of deals like this globally with a bunch of different businesses. Again, going back to the storage business point, right? We want exposure to the assets, and if we can be that long-term holder, I think there's great partnerships there. And then probably the last piece on the asset-backed space, because I think when we started this business, we were generally trying to essentially do transactions where you're trying to make sort of low to mid-teens. So just put that sort of number out there. I think we've seen more and more capital being raised, and we've been very active in more of the investment grade part of the market, right? So the top of the capital structure, very, very kind of low probability of loss, but looking to pick up that additional yield. That's been a big popular place for kind of insurance companies globally, pension plans, as they think about, especially with where rates are, can you earn 7% to sit in that IG spot? It's a pretty interesting place to be.
Okay, so what about M&A?
Yeah, I think when we walked into the year, you could have had a general consensus with everybody in the industry that this was going to be a gangbuster year, maybe too much consensus. I think you're going to see things pretty slow for a little while. Right, I think there's still deals to do in the market, but the direct lending market does thrive in an active M&A sort of space. I think that's more of a U.S. kind of view, right? I think you will still see a fair amount of activity, or at least more normalized levels kind of globally, but the U.S. is the big sort of numbers. I think with what's going on and the uncertainty around all of these sort of tariff type conversations, it's going to be sort of slow going. Now that said, we do know there's a lot of pressure from LPs on private equity GPs to return capital, right? We do know those funds are getting longer sort of in the tooth. As I mentioned before, there's a lot of dry powder in the private debt markets to finance it. We know the capital markets have generally been open and very active this year, so there's a willingness to get deals done. But I think the idea that 25 was going to be this big gangbuster year for M&A is probably not correct.
So there's been ongoing debate around transparency and private credit valuations.
Yep.
How do you respond to that?
Yeah, we have gotten that sort of question from time to time. I think people need to understand the process a little bit because, like I said, I worked at banks for 17 years prior to being at KKR for the last 10. I'll pick on our valuation process, but I think all of the other large players would have something very similar. I think our process is as robust as those bank processes, right? So, while the deal teams and the portfolio managers are responsible for setting these marks, we do employ third-party valuation providers, right? And they are kind of working with the teams. They are providing ranges for where they think would be acceptable for these assets to be marked. So there's some true independence in here. We have to sort of be within those ranges. And these are valuation providers who are doing it for multiple sort of parties across the industry. So, I think that's pretty robust. I think there's other sort of, checks and balances in there. And like I said, I don't think that's KKR only, right? I think the industry is really focused like that. So I think the valuation point is honestly probably unfair. They are level 3 assets. I think everyone could have a slightly different policy, but I think it's rooted in points like that. I think if investors do have concerns about it, they should call their partners and really get into the weeds and figure out how these assets are sort of being marked. And, I think the one comment that does come in volatile times is the marks don't move as much as the public markets do. I think that is true, right? The public markets, in times like this, there's generally not a lot of liquidity, right? Certain trades can move prices sort of quickly. As I said before, like spreads have only moved probably 25 basis points. So I don't think you'd see a lot of, kind of moves or quick moves in the private debt space.
Dan, thank you so much for sitting down with us and sharing your insights and knowledge about the private credit market. And I hope you enjoy your time here in Australia.
Great, thank you. Thanks for having me.
If you like that video, don't forget to give it a like and subscribe to our YouTube channel where we release new content every week.